April's unemployment report shows a robust job market and continued wage growth, which may not be good news for people who are looking for the Fed to cut rates. That brings us to Yahoo Finance's Jennifer Schonberger with what this jobs data means for the Fed's path ahead. Jen?
Good morning, Brad. The latest jobs report showing the job market remains strong. You saw the unemployment rate drop. You saw average hourly earnings actually tick up month over month, year over year, came in higher than expected. And of course, that non-farm payrolls number clocking in higher than expected. All of this likely to influence the Fed to nudge rates a bit higher. And you saw them keep their options open in the policy meeting this week. And rightly so, given the data that we're seeing come in this morning. The Fed really wants to see a slowdown in the job market, and this report's still showing strength. The Fed sees bringing down inflation by slowing down the job market. Officials believe the strength in the job market is feeding inflation higher, both in terms of sheer number of jobs created and wage growth. So if the job market is too strong, the Fed will move to push rates higher to slow down job growth to bring down inflation. Now, they are particularly attuned to that so-called services inflation excluding shelter, and this one tends to be closely tied to labor costs. It remains particularly elevated, and it would require wage pressures to ease more. And we saw really the opposite of that in this jobs report. So all in all, the non-farm payroll number coming in at 253,000, certainly a slowdown in strength from what we saw earlier this year, but perhaps not enough of a slowdown. Because if you look at the Fed's dual mandate, they've got the job side of the equation and they've got the inflation side. The job side clearly hanging in despite 10 consecutive rate hikes over the past year, which means that leaves room for the Fed to potentially nudge the Fed funds rate maybe one or two more times here if they feel the need to do that. And I will get more insight from the Fed themselves when I sit down with Chicago Fed President Austin Goolsbee Monday morning at 11 a.m.
Awesome. I'm looking forward to that, Jen. I keep hitting refresh on my CME Fed Watch tool to see if what people are pricing in for June. And it keeps moving around, but there is
it's very volatile.
Yes, of course. But there is a small chance being priced in now of another increase at the June meeting. Right now, it's 3.9%. It was as high as 8.5% right after the numbers. I'm sure that's something you're going to talk to Austin about. But, it's interesting. That was something that a lot of people had taken off the table.
Yeah, I wouldn't be surprised on the back of this number. Like I said, that wage growth really coming in much stronger than expected, driving the bus on this. And Goolsbee is interesting because going into the last meeting, he actually thought that the Fed should move more cautiously, though he voted in favor of that 25 basis point rate hike. We'll see where he stands now on the back of this data.
We will. I'm looking forward to that conversation. Thanks, Jen.